Australia's business channel. The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. My name's Mark Todd. I'm from FIIG. And if you have any questions on tonight's show, please give us a call on 1300 30 34 35. We've got lots of emails already. The email is yourmoney@skynews.com.au. Joining me tonight is Rad Kraberbach from 70 Capital and Dr. Stephen Nash from FIIG Securities. Welcome, gentlemen. How are you?
Very good, thanks, Mark.
We thought we'd bring the doctor on. You're head of the strategy at FIIG, and I thought you'd be a great intro into what's happening in the markets. You go and visit a lot of customers and you go to a lot of these conferences. And Rad, you've got your own, essentially a private equity business. Prior to that, you were head of SocGen in the fixed income market. You were head of Toronto Dominion in the fixed income. So you've got the Canadians and you've got the French.
There you go.
A French Canadian. Wanted to work for those guys. And
Absolutely.
now you've left that and you've moved into your own business. And at the moment, it's more the private equity space, but you'll be moving into maybe more the broader distribution later on. Is that right?
Yeah, absolutely. Just to give you, I guess, a rundown of 70 Capital. So,
Great.
70 Capital is an absolute return fund. It was established in 2008. And what the objectives of the fund are is to try and generate a return, an absolute return in all types of markets, so irrespective of what's happening. Our focus is really to try and achieve about 7% above the 3-year government bond rate. The way that we do that is we really only focus on liquid asset classes, and the primary focus is really on global fixed income, some commodities, currencies, and also some equity indices. On top of that, what we've basically got is 3 portfolio managers who have over 20 plus years experience in trading global markets. And I guess from a return standpoint, the last 12 months, although it's been quite volatile, we've been generating probably around 9% return. That's after fees, and since inception, which was mid-2008, it's a cumulative return of above 45%.
And sorry, what did you say you're trying to... What was your benchmark? It's
7% above the 3-year government bond rate.
7, that's a big number.
Well, I guess in that hedge fund space, to be relevant, yeah, you've got to make a reasonable return.
And one of those things with all that sort of business is you've got to try and get your own track record, because then you want to go into the broader market and bring that years and years of experience, but no one can give you money. At the moment, you've got sophisticated investors who are able to give you money, but in terms of getting through the planner networks and all the distribution panels, you really have to have that framework of what you've been able to do, isn't it right?
Yeah, definitely. It's always a challenge in starting, I guess, startup funds. The main challenge is really the distribution aspect of it. What we've been doing over the last 4.5 years is predominantly building a track record. We do attract money from high net worth individuals, but now the challenge for us is to try and grow that business by getting on some bigger platforms, or even potentially finding a larger equity partner with a broader distribution base.
Yeah, right. Because I mean, we see with Challenger and places like that, they're always looking to create a boutique fund so they can go to people and say, hang on, we have a slightly different edge. And there's a few organisations like that. There's Treasury Group, there's Challenger. A lot of people make that part of their business model, don't they?
No, definitely. The incubator space has been growing, I guess, quite exponentially. It's a model that produces pretty good returns, I guess, for those entities. You've got a few US-based incubators now also targeting the Australian market. One thing that Australia has, it has a very good pool of talent.
Right.
And I think everyone's really identified that. And on top of that, the funds management space in Australia is growing, quite exponentially.
Yeah.
We've got 1.9 trillion under management here, and so it's a pretty big pool of money to tap into.
We punch above our weight, and bringing the big puncher is the doctor. Oh. Hello, mate. I suppose one of the things I wanted to know, and I wanted to have the viewers be aware of, is you've been going to some conferences around portfolio construction, and
Yep.
What are the themes that you're hearing from people who are trying to construct a portfolio right now?
Look, I think generally people are trying to be much more conservative in their portfolios. I think the high savings rates that we've seen the Reserve Bank refer to quite a bit is indicative of that, and I think generally people are not looking for high volatility in their portfolios as they saw throughout the financial crisis. So they want a better portfolio construction, they want less volatility, they want roughly the same return. I think there's a lot of opportunity with bonds in that portfolio construction going forward. Another major concern for people is inflation. There seems to be a concern about the easy monetary policy stimulating inflation and also currency devaluation stimulating inflation globally. So people want protection against that.
Do you feel that within the environment, whether it be the advisors or the investors themselves, there is a little bit tired of the volatility, they're shell-shocked around the fact that they don't want to be as actively involved. When they set up the super fund, they didn't anticipate it to be as aggressive as it is, the volatility and the effect it has on the lifestyle. Yep. You know, we talk about a lot the way that people are looking at volatility in an entirely different manner now. It's really hurting in some respects, isn't it? Yeah,
well, as I said, I think from looking at the savings rate, that's showing you that people really don't want to, they don't want to borrow as much as they did, they don't want to take as much financial risk on as they did in the old days. You know, we've got a savings rate at a multi-decade high right now. The RBA expect that to continue, and I think investors expect their portfolios to be less volatile going forward, and that means a lot more debt. You've seen a lot of debt on issuance on the exchange. Yep. It's going to continue.
We have an email. Our first email for tonight is from Rebecca in Terrigal, and she says, "What is a bond and how is it different from equities?" Now, I will admit that we did get this one sent in a little bit earlier because Sky was good enough to come and tell us about it. We were able to create a chart. Could you bring up that chart for us? Without the ums.
Yeah.
Do you want to talk about how bond is different from equities? Can I ask you to lead off? You are the doctor.
Yeah, look, I think the main difference between a bond and an equity is the position you are in the capital structure. Equities are at the bottom of that structure, which means in a wind-up, typically there is no money left for the equity holder. And the bonds that we typically sell are what we call a senior-rated bond, which means that equity holders are typically wiped out, and whatever's left will go to the senior bond holder. A bond holder is like a banker to the company that you're lending money to, whereas with an equity holder you're basically owning the business. So it's a completely different perspective. The bond has a much less volatile return stream, whereas the equity is much more volatile.
So Rad, I quite like that. There must be a point in time when you're, as an investor, you want to be the banker, and there are other times you want to be the share owner. You want to own the company. I mean, is that part of the skill, do you think, in becoming a good trader?
Absolutely. It all really depends as well where you are in the economic cycle, I guess, and what role those asset classes really kind of have to play. Right here, right now, if you, I guess, take a look at where we are, the equity market has had a significant rally, over the last 12 months, even more. So you're probably, from an opportunistic standpoint, there's probably a little bit more value in trying to preserve capital, and that would probably mean having a high allocation to fixed income.
Yep. We have our first caller in tonight. It's Fabian from Sydney. Hello, Fabian.
Yeah, good evening, and thank you for taking the call.
Pleasure.
I'd like to ask you two questions, if you don't mind. One is on SBKHB, that is the Suncorp perpetual floating rate bond.
Yep.
The other one is regarding the international bonds that are sold not to retail in Australia, but in big quantities, like each bond is $500,000, and I think FIIG is offering or has a business that is break it and sell it in Australia to retail investors. In that case, what type of risk do you think is added by buying straight through FIIG? Because I guess FIIG is opening a trust and holding the bonds in trust. So do you think that adds some sort of risk? And regarding Suncorp bond, how would you compare that bond with NABHA or any other bond from banks? I know Suncorp is a lower tier, more risky bank, but how would you compare in terms of how much more would you have to be paid to hold that bond?
Do you know the Suncorp?
Not off the top of my head.
Suncorp's an A minus. I think it's an A minus rated bank, and I don't. And they're great questions, Fabian. We'll go through both of them. I think the thing with the Suncorp was that they are trading quite lowly at the moment, isn't it right?
We've had a massive contraction in credit spreads of late, and what's happened with some of the major banks have come out with some of these tier 1 issues, which are very risky, very low on the capital structure. these deals would not go be sold in the wholesale market because the spread's not wide enough. So the issuers are really taking advantage of people who want more conservative cash flows, and the wholesale market just rejects that sort of level.
And for Fabian, we'll come back with some information on the Suncorp. But in terms, you mentioned the NAB caps. I think one of the things is that the secondary market offers some great opportunities compared to where the hybrid market trades, in that there's no trading in the hybrid market. There's not much volume. So if somebody wanted to come out with a big sale in the Suncorp, that price would diminish quite rapidly. It's just that there's not that sort of liquidity because I think, Rad, in my mind, it's the last thing you want to sell. It's the hybrid you bought because you want the dividend, you want the coupon. So there's not that sort of liquidity. People buy it in a few thousand, they buy it in tens and tens of thousands.
Absolutely. They're kind of set and forget strategies, once they hit the market, because there's not a lot of issuance in that space. They get snapped up very quickly, particularly by the retail investor base.
Yep, and in terms of the second question about the service that FIIG offers, it's a custodial service. It's a separate service to FIIG in respect of how it's reported and how it's audited. There is an audit that takes place called the GS007. It's, without wanting to spend hours talking about it, the reality is that it's incumbent on everyone to try and get into this market, and so that we've created that capacity via the custodial business where you get segmented part of the bonds. The only reason it trades in $500,000 denominations is an anachronistic behaviour of Austraclear, isn't it? It's about where you have chess, you have the equivalent in fixed income. Am I being too...
Well, that, and also bonds that are issued under Australian law, they have minimum denominations of 500,000 because they're primarily targeted towards institutional investors or sophisticated investors, so to speak.
So they've got to be a seasoned bond, which is in the documentation it has to be 18 months or whatever the duration might be, and once that becomes seasoned, they're available to another type of investor, which is not those institutions with 500.
But if you're a retail investor and you want to take advantage of buying potentially smaller denominations, you can either do it, I guess, via FIIG, and they can do a lower allocation, or there is the Aussie Eurobond market, which is quite an active market globally. I think there's probably the best part of $30 billion on issuance in that market, and the minimum denominations are down to 1,000.
That's right. I mean, but we'll talk about that after your speed dial, because we'll talk about how the global market for fixed income is entirely different to what we have in Australia. And what we're trying to suggest in fixed income sounds very scary to a lot of people, because they're saying, hang on, what is fixed income? And I think the focus has to just be on the education. Once you've got the education down pat, then it becomes much easier to understand whether it's appropriate to buy that bond. At this point in time, you're buying a piece of BHP. It's a different sort of understanding. You think, I'm very comfortable because you get a chest report. Well, custodians and the way bonds trade, they're secondary market traders. And the rest of the world is very comfortable that's reported. So it's interesting to see how we've got to change the psyche around what's an appropriate investment for everyone. The rally, equity rally. You wouldn't want to miss this. I mean, it's been a good rally, so you're not saying, Dr. A, you only buy bonds.
No, look, I think equities have got obviously a solid place in any portfolio. It's always a question of how much you should have. If you have a look at the numbers, obviously equities have a lot more volatility than return. Bonds have a lot more return than volatility. But when you put them together, they really work well, because when you add bonds to the portfolio, you add interest rate risk, and that can be a really big diversifier in very tough times for equities.
The mission statement, that's the one, isn't it? It's about how you construct that portfolio so that you lose that volatility. What about you, Rad? What do you think of this equity rally?
Well, it's been an unbelievable rally, but I think everyone has to be aware of the context of the rally and what's been the main driver. And unlike, I guess, historically, in the last several years, we've had unprecedented quantitative easing by central banks around the world. So that's created an excess cash supply, excess liquidity out in the market, and the main beneficiary really has been the equity market.
Now, on that note, keep going. You have 30 seconds. You know the 4 questions. It's cash, it's currency, it's debt, and it's equities. Your time starts now.
Okay, the official cash rate, 2.75%. The Aussie dollar at parity. Credit about 25 basis points wider, and the ASX 200 around 4,400.
Now, when you've got 19 seconds to go, you really should have filled that out. You need to be able to say, okay, from 3 it's down to 2 3/4, but I get it.
There you go.
So you're not seeing that great a movement in the cash rate. I think the cash rate becomes the answer for all of it, doesn't it?
Well, I think so. We're towards the end of the interest rate cycle, really. At the end of the day, there might be another 25 basis point, but that probably...
And on that note, you've got 30 seconds up.
Australia, you need a break. And with these great great low fares from Jetstar, now's the perfect time to take one. Take off from Melbourne Tullamarine to Launceston from $59 and Sydney from just $65. Or take off from Sydney to Launceston from $89 and Darwin from just $179. Fares are one-way, checked baggage not included, but may be added for an additional fee. Not available on all flights or days. Conditions apply.
For details and to book, visit jetstar.com.
At Nissan, the big one is back. We were first with 1% finance, and now it's back with 1% comparison rate across the Nissan range. We even put it on the all-new Nissan Pulsar. Get into your Nissan dealer by March 31. Leave it.
It's so frustrating when sprays don't kill cockroaches instantly and they get away. Stop the chase with Mortein Kill and Protect. It kills cockroaches 2 times faster than the next competitor. Mortein stops them in their tracks with just one spray, while the competitor gives them a chance to escape. Plus, it works as a protective barrier for up to 6 months. Kill cockroaches 2 times faster with Mortein Kill and Protect. What's new where you see it first.
At Sage, we have over 6 million customers, and that makes us a leading global supplier of business management solutions for companies with up to 1,000 employees. Like Sage 300 ERP, previously ACPAC, our small to mid-sized business solution with more than 40,000 customers in 160 countries worldwide, deployable on-premise or in the cloud. With credentials like these, we must be doing something right. So call us on 13 Sage.
On Saturday Agenda, will the first cut be the deepest? We'll ask Shadow Assistant Treasurer Matthias Cormann how the Coalition can axe 2 taxes and still balance a budget. And we'll look at why Labor's heartland is losing the faith. Saturday morning on Sky News.
Welcome back to Your Money, Your Call, and tonight I'm joined by Rad Kraverback from 70 Capital and Dr. Steve Nash from FIIG Securities. They're here to answer any of your questions, so please pick up the phone and call us on 1300 30 34 35, or you can email us, and the email is yourmoney@skynews.com.au. Gentlemen, I just wanted to talk about that bond market. So, Rad, you were talking about the global market for bonds, and so we've just got a chart that we wanted to start off this segment with, and it's to talk about global investment in fixed income and how Australia compares with the rest of the world. Now, we've edited this chart so that it can fit within the structure of the TV and the screens, but we've derived it from a OECD report on allocations. Now, the allocations in the markets are Australia it's all in green is the fixed income, the blue is the cash, to the right, I think that's going to be a grey colour, is essentially that's property, isn't it?
Majority property.
Yeah. Alternatives, yeah.
And then equities on the left. And you can see where Australia fits, don't you? It really stands out how we compare with the rest of the world.
If you have the full chart, and there's quite a lot of countries involved there, you see that Australia is right at the top in terms of equity allocation, and it's also one of the smallest allocations to bonds. So we really have this fixation with equities, and we have an aversion to the bond market, which I think in the past has led to a lot of volatility in portfolios, which people have, I think, gotten very sick of.
Would that make sense for you?
Yeah, absolutely. If you take a look at all the OECDs, as Stephen mentioned, we have the lowest allocation to fixed income. And I guess when you take a look at the funds under management in Australia, we're sitting at that 1.9 trillion. About 1.4 trillion of that is actually super money.
Yeah, right.
Now, the demands of those super investors are changing somewhat significantly, where they're more focused, as we mentioned earlier, on capital preservation and some form of income generation. And
I look at Germany. Germany's under 10% in equities, which seems strange. I would have thought the Germans would have been much more vibrant around that equity piece, but they're not.
Well, Germans being
conservative,
being sort of an engineering type of society, very very focused on risk as well as return. They have a very large allocation to bonds and very very small equity allocation. So in terms of the GFC. Those portfolios just cruised straight through that. Obviously, the bond portfolios are doing very well. Equities being small, almost not affected. If you do a few studies, doing a reverse of the normal 75% allocation to equities and reversing that and putting 75% in bonds, you can cut your risk dramatically. And I think that's really important.
But okay, so upon doing that, everyone who's sitting there on the lounge at home would say, "But my return will be 3% or 4%." What does it do to your portfolio if you allocate, as we're talking about here, fixed income?
Well, if you did that reversal relative to the typical balanced portfolio, which they say has got 75% equities, which I think is a misnomer. Anyway, the reduction in return is about in the order of about 60 basis points to a percent, but your risk is cut by about 10 times that amount. So you're getting a substantial cut in risk for a small cut in return.
So Rab, when we talk about risk as a concept, what we're talking about, I guess, is the fact that it moves up and down. It might still move slightly forward a few percent, but you had a 10% up, 10% down and a 2% up. Is that what we mean by risk?
Pretty much. It's basically you draw down on your capital, and what tends to happen is the investor base now is, since the GFC, has become very focused on trying to minimise that risk and protecting their capital. You obviously have the problem of entry and exit and the timing of when you get in and when you get out of things. So the key thing is to protect that capital, and fixed income does play a very important role in allowing you to do that. So
we talk about the fact that the global markets, you can buy $1,000 bonds and euro bonds, and I completely get all that. A lot of people like the idea of going to a fund manager, and they might come down and say it's just too hard. So tell me about what fund managers, what are they doing at the moment?
Yeah, well, I guess from a fund manager's standpoint, there's within the fixed income space, you've got probably two different types of managers. You've got the index-based managers who basically track an index, and that index is like the UBS Composite Bond Index. And then you also have the active fund managers, and the active guys are probably a lot more focused in providing an absolute return, which is a return in excess of the cash rate or the bank bill rate. And the way that they do that is they're very proactive in their portfolio construction. And what tends to happen in an environment where you've got rising interest rates, they obviously will outperform the index because they're a lot more prudent in trying to preserve that capital.
When we talk about the bond market, what are we talking about? You know, for the viewers at home, every time they hear about the bond market, they think government bonds, don't they?
Yeah.
I mean, we had an email earlier. I haven't been able to get that one up. It was Matt from Sydney. He said, I have a portfolio of bonds, and what is the bond bubble, and should I be worried? And I was just thinking about that in terms of what you were saying. What is the bond market? You know, and let's talk about Matt's email about bond bubbles in a second, but when you're talking active managers and you're talking about the bond market, what are we talking about?
Well, in terms of bonds, we usually think about the fixed income universe is embracing a whole range of securities. At the bottom, in terms of yield, is government. Then we have the semi-governments or the state governments. Then we have the corporate issuance up to investment grade. So the yield goes up and up and up as we get higher and higher risk. And then we get what we call sub-investment grade, or what the Americans call junk bonds.
Junk bonds. So Wesfarmers came out and did an issue today. I think it was, I don't know what rate they traded at. Do you know what the rate was at Wesfarmers?
About 110.
110. And so $750 million, and people will buy Wesfarmers debt. And that's the corporate bond market, isn't it? So that's what. So your fund manager will be looking at that sort of bond.
Oh, absolutely. And one thing in Australia has a very large concentration in financials. The majority of issuers that issue in that market are predominantly financials. So any corporate issuance is relatively scarce, and they tend to get snapped up very quickly.
So non-financial. So we've got David from Sydney on bonds. Hello, David.
Oh, hi there, team. Hi, Mark and Stephen and co. Listen, there's a simple question, just relating to where do you think the place of bond ETFs is, as issued by a range of providers, including UBS and Vanguard and whatever, and can they fulfil part of the role that you hope bonds might fulfil in a portfolio?
Great question. Thank you, David. ETFs. Can I start with you, Rob? What do you think on ETFs?
Yes, certainly. I think they've got a great role to play in giving retail investors access to the market. The only issue with some of the ETFs is they tend to be very much index-driven, so they're just really index trackers, and that can create a bit of a problem depending on where you are in the interest rate cycle at the time.
I've got to tell you, it's a bugbear of mine. I don't like index trackers. What do you think?
Oh, it's good. It's good that these products are available for retail investors to trade. I think the ETFs are a really good way to get your asset allocation right. Most of your return is going to be driven by your asset allocation. So having a cheap product there that doesn't cost you too much in terms of fees, and you've got to check those fees. I think that's an important point with the ETFs. Make sure your fees are low. But I think they provide a good access point for investors.
I mean, I suppose the thing with index tracking is that it's just a computer model. I mean, my 10-year-old's probably better at Excel than I am, and I think in a couple of years' time he can show me an index model and I can track that. But I would rather think that, and one of the things we've had going in the show is the number of self-managed super funds that have evolved. I think it's 588,000, growing at 3,500 a month. To put those customers into index tracking businesses, I would rather they spend a little bit more time in getting familiar with it and working out, is Wesfarmers a good deal at 100 turnover, or should they buy Bureau sub at 250 over, rather than just saying, well, let's just go with that herd. And I feel, in lieu of trying to save a few points, I think they need to take a bit more time on the education. I mean, am I barking up a wrong tree?
You're right in one context, but the biggest problem with self-managed super funds is obviously their size. So the average size is just above 500,000, and when you consider minimum denominations of Australian fixed income securities of 500,000, it makes it somewhat difficult to participate. That's where the ETFs gives you some access to the market. But in saying that, you're probably better off choosing an active fund manager out there in the market who can probably take a denomination of 50 to 100,000 and allocating some funds to that, and at least you'll get a more diversified portfolio.
Yeah, I think there's an element around, as we've seen so many times, people come in and they'll have a portfolio of different investments, and they've got the Chinese bond out of some different fund that's been created for them. They put money into that, and so I suppose it's about a question of education around what's going to be good for you, what returns should you expect, and what's the volatility like that you can accept.
Well, self-managed super funds are really created for the direct format of investing. So, investing directly in equities or directly in bonds really does make a lot of sense. Obviously, you've got to do your homework, but the good thing about it is that you don't have any fees on an ongoing basis, and you've really got that control. And I think a lot of people want that control in their investments these days. They don't want to wake up to some fund saying, "I'm sorry, but we couldn't sell this bond or that bond." They'll know what they've got. I think that's reassuring.
And the same with equities. I mean, I'm not saying it's only on fixed income. I'm saying it's all with equities as well. I mean, we had Roger Montgomery here a few weeks ago talking about the fact that it's all about you need to be comfortable with the stock that you're buying rather than the price. He would say that forget the price, just look at that stock and say, is that the right point? And there is different trading strategies around entry price and buying. But he's right. It's all about education. It's about limiting your choices to something you're comfortable with and then buying that comfort. And it makes some sense. I mean, you must be doing the same thing with some of your strategies.
Yeah, definitely. I mean, at the end of the day, it's all about risk management, what you're really trying to achieve with your investment. So you really need to have a thorough understanding of your risk profile and really your risk appetite. And then within that, you can start breaking that down and finding the right allocation, whether it's fixed income or equities, and then breaking that down even further.
Or even properties. Just I mean, some of the commercial property prices are quite cheap, and you can get some great returns if you're in the right spot, if you're in the right sweet spot where you can't be too big. Those guys push you out. That's the key, isn't it?
Yeah.
I'm looking at the clock, Doctor, because I know that you want that speed round really to rally hard.
Okay.
Now, we're going to talk about inflation after that speed round, because one of the things that we've noticed is we've got a lot of emails around inflation, so we've got a segment on it, because I feel that that's the real driver in a lot of people's conversations at the moment. How to mitigate the ongoing costs when you get your energy bill and it's higher, and they say CPI is only at 2.5 and it's all right. You just don't feel like it's at 2.5. You feel costs are just booming. So I think it's important to try and get that inflation piece right. So hold on to those thoughts. In terms of you, Rad, business is pretty good at the moment in the business that you're doing. The performance is really good, but how's the rest of the year look like?
It's going generally relatively well. The markets have been somewhat volatile over the last 6 to 12 months, but it's provided some phenomenal opportunities as well. It's just getting your timing right and your allocation right at that right point in time.
Opportunities, and it keeps you awake at night. Now, Stephen, be prepared. We're about to go to a break, and I need you on the speed round, and it starts in just a few seconds.
The cash rate. We're looking for another 2 interest rate easings, leaving the cash rate around 2.5% by the end of the year, waiting for the RBA to assess what they've already done and then continue with a few more easings towards the end of the year. Looking for equities to perform around 5.5% for the whole year, and 10-year bonds about 2.9 by the end of the year.
10-year bonds, 2.9. From where?
From about 3.5 now, so a little bit of a rally.
Okay.
And listen, the big one is back. We were first with 1% finance, and now it's back with 1% comparison rate across the Nissan range. We even put it on the all-new Nissan Pulsar. Get into your Nissan dealer by March 31. Leave it.
Australia, you need a break.
And with these great low fares from Jetstar, now's the perfect time to take one. Take off from Melbourne Tullamarine to Launceston from $59 and Sydney from just $65. Or take off from Sydney to Launceston from $89 and Darwin from just $179. There's a one-way, check baggage not included, but may be added for an additional fee. Not available on all flights or days. Conditions apply.
For details and to book, visit jetstar.com.
When it comes to a freight partner, size and innovation matter. Our huge network and 3,000 vehicles guarantee fast, reliable delivery across Australia. We're proud of our history and our growth. It's a tribute to our people and their dedication to customers, providing fresh logistics solutions and new ideas like auto-sort technology, supported by a service-first commitment and total care for every package. Bigger, better, faster. Star Trek, when service matters.
The CommSec app gives you more than one view of the market all day, every day, allowing you to manage your investment portfolio on the go. With access to live quotes, charting, watch lists, live market indices and exchange rates, you'll have all the tools to buy and sell shares right at your fingertips. Featuring smarter navigation, improved performance and access to multiple daily market updates. Visit the App Store or Google Play Store and download the CommSec app today and make every second count.
On Saturday Agenda, will the first cut be the deepest? We'll ask Shadow Assistant Treasurer Matthias Cormann how the Coalition can axe two taxes and still balance a budget. And we'll look at why Labor's heartland is losing the faith. Saturday morning on Sky News.
Welcome back. On the panel tonight we had Rad Kravovac from 70 Capital and Dr. Stephen Nash from FIIG Securities. He's the strategist at FIIG. If you have any questions, please give us a call on 1300 30 34 35 or email us, and the email is yourmoney@skynews.com. Anything on the bond market we'll be very happy to discuss. Gentlemen, we do have a few emails to start with. We've got James from Melbourne. Banks seem to be issuing more and more hybrids. My understanding is that hybrids are similar to bonds. Why are banks issuing these hybrids, and are they better than bonds? Doctor?
Well, just with regard to the recent issues, I think James is probably referring to some of the Tier 1 issues by the major banks. The Tier 1 securities are quite a lot more risky than your typical senior bond. And the issues that are coming out of late, I think, are really indicating that the issuer is in the driver's seat at the moment, and they've really got a good compression in spreads. These issues probably would not have been issued into the wholesale market because the wholesale investors are saying the spreads are too low. But because people are looking for supposed low volatility investments, the banks are really taking
advantage of it. That's not like banks.
Effectively taking advantage of people who really want these low volatility returns by giving a security that really wouldn't fly in the wholesale market.
What do you think, Ray?
Yeah, well, I think really at the end of the day it's a cheap source of funding for the banks, and they're really taking an advantage of the market conditions, you know. So, but yeah, generally speaking, hybrids do have a role to play in a portfolio. It's just, I guess, your entry time and your perception of value.
It is true that it's the banks are taking advantage of the cheap funding. I mean, I am conscious of that, and good luck to the banks. But at the same time, they need to try and develop a corporate bond market, don't they? The banks need, if it's in hybrids, if that's what they have to do, if that's the vehicle, so be it. But the banks know that offshore funding, though it might be cheap at the moment, ultimately they need to be local. They need to get into that self-managed super fund. They need to get into that insurance piece, don't they?
Well, yeah, I guess that definitely. Yeah, the banks have very large borrowing programs, and always trying to source money from the offshore markets. For the domestic banks, they obviously have to compete with the other offshore banks in the offshore markets, which pushes their cost of funding up. You know, issues like this, where you can tap into the domestic retail market, obviously provides a lot of sense. Not only that, if you take a look at the build-up in term deposits, has been quite excessive over the last few years, and now you're at a point where the returns on those term deposits are relatively low, so the banks are quite conscious that investors are looking for alternatives. Yes. And the best way to go about it is obviously produce a product and get access to that money as well.
Hello, I just happen to have a product for you.
Yeah, having driven the cost down, they've created a product. That's very smart work.
Well, I think it's really, I think the banks have been fortunate in the sense that there's been a bit general contraction in credit spreads. It's really been the investors driving those spreads down.
Well, when you talk about a contraction in credit spreads for the viewer at home, you mean that the rate at which an investor will lend to a bank has lowered. So the rate that they're prepared to take is less because they want that safe haven. Is that what you mean by?
Absolutely. So basically, where an investor is willing to lend money to a credit going out of the credit spectrum, so from a financial institution to a corporate, the premium that they expect has come lower.
So if National Australia Bank is out doing a corporate issue and Telstra comes out to do a corporate issue, essentially Telstra could probably borrow money at cheaper rates than National Australia Bank, do you think?
Well, potentially, maybe not Telstra, but corporates. Yeah, Telstra's got a whole bunch of bonds. They've probably saturated the domestic market from an institutional standpoint, but there are corporates that actually haven't been to the market historically, and a good example is Toyota, which did a bond issue not so long ago. They really haven't had an institutional-based deal in the market. That deal came relatively flat to where the banks are trading. Right. Toyota's AA- credit as well. So there's probably a greater demand for corporate debt due to institutional investors wanting greater diversification away from the financial sector.
Because the institutions have all bought the four majors, they've bought JP Morgan, they've bought... Because clearly, for the viewers at home, other banks offshore come in and borrow money from us as well. Yeah. So all these fund managers have got a lot of banks, and they say, I wouldn't mind anything other than a bank at the moment, just to give me some balance in my own risk. Yeah,
look, I think there's a lot of discussion about creating a corporate bond market in Australia. I think we have a thriving institutional market. The market we haven't got is the OTC market for less sophisticated investors. At the moment, the exchange is trying to get everything done on the exchange, but globally, bonds trade over the counter. So I think, going forward, it would be good to encourage both forms of distribution, one on the exchange and one over the counter.
With our first slide, our second slide about the diversity of the market globally, a lot of those bonds are all trading over the counter. In other words, they're not on an ASX, they're not on the stock exchange, they're on a different vehicle. And that's quite acceptable to a whole range of different investors who are retail investors or sophisticated investors. Isn't that right?
Yeah, well, I think there's an underlying concern that there's a possible lack of transparency, but with technology these days, there's ways of solving that, and they really need to be explored, I think, to allow people greater access to the OTC market.
And I don't want to, take a big stick and belt the ASX, because that's not my nature, but it'd be fair to say that when you look at the ASX and the fact that they might want to do a deal with the Singapore Exchange, they're looking for different products. One of the products that the ASX would like to have would be fixed income, because essentially they can earn fees. Yes. Am I being rude to the ASX?
No, not at all. I think the ASX would like as much product as possible, whether it's fixed income or whatever it is. The more product that they have, obviously, the greater fee structure that they achieve.
And most of the issues of late have been, guess what? Debt issues, because that's the sort of issue that people want in this changed environment. High savings rate, more conservative, debt issues are what is expressing an underlying need by consumers.
And I do believe, I've spoken to the ASX about this thing, I do believe that they believe that it's great to be on exchange because of the way that the markets have adapted through equities. People like to see it. They like to look at a computer screen and see it. That's mine, that's mine, that's my equity piece. And that's a psychology. It's hard to understand, but it's literally just logging into a computer screen and saying, I therefore feel better about it. And maybe people will have to, either adapt or the market adapts to give them that same feeling, whether it be that computer system.
Sure, but I guess since the GFC there has been a lot more functionality and development with respect to transparency in fixed income and global credit markets, particularly all OTC markets. So there's a number of third-party market providers that give you all independent pricing on a range of fixed income issues and credit indices.
Yeah. We want to talk about inflation, Stephen, Brad. Now, we've got some emails that, it's at the forefront of a lot of people's minds. We've got some emails that we'd like to share with you. The first is from Mark in Melbourne, and Mark says, with the Federal Reserve printing all of this money, surely inflation will become an issue in the US at some stage down the track. When do you see inflation becoming a problem in the US? and will those inflationary pressures reach our shores at some stage? And if so, how do they flow through to us? The other thing is, what is the best way to protect myself against this inflation? And following up, we've got another one as well from Darren from Manly, and Darren has said he's got a very similar question. With the amount of government expenditure, and I think he means all governments, or for a better phrase, money printing, so that is definitely all governments, I'm concerned about inflation going forward. What can I do to protect my interest rate investments? Can I start with my inflation expert?
Look, I think in terms of worrying about a lot of inflation from the US at the moment with unemployment where it is, it's probably you're looking in the wrong area. I think with the supply of labour that they've got at the moment, it's quite unlikely that they're going to get inflation out of control. The Fed has been very insistent that it's also looking at inflation as well as unemployment. But further down the track, there's a possibility of inflation. But I think the real hotspot for inflation is possibly the Middle East, with a lot of the conflict there leading to higher oil prices. Now, that could be a real shock for people, and we've seen this before, high oil prices, a lot of inflation. People need protection, and I think a good way to insure directly against that is using inflation-linked bonds instead of equities.
Red, why are they worried about inflation? What is it?
Well, I guess the big issue is with inflation, it actually erodes your purchasing power and decreases your real rate of return. And, obviously we're all out there paying bills every day, so you're always questioning your purchasing power in real life. But in reality, at the moment, inflation's not really an issue, even with the Fed, printing money the way that it has been printing. You've really got no wages pressure growth at all coming out of the United States. And there's a lack of credit growth as well. So money supply is really under control. And until you get those two aspects probably kicking slightly out of control, inflation is probably a non-event. But going forward, at some point in time, I guess when the quantitative easing has to be unwound, that could create some inflationary pressure. Where's that sit in the foreseeable future? I don't think it's a concern really for the next 12 months, but beyond that possibly. And I guess ways to protect yourself is obviously, as Stephen said, some inflation-linked bonds. Obviously, you could take a look at some commodities as well, or commodity-linked type of shares, gold, or direct property investment as well.
I mean, I think they talk about this constantly, about the jobless recovery in the United States. And it's clear that there's a disconnect between what Bernanke's trying to do, he wants employment down, and the lessons taught to corporates about productivity. So they will say, Rad, you can work longer for less and you should be happy to have a job. And you'll probably agree. And you'll probably work much harder. And I think that's a very hard policy shift that he'll have to create, whether it be through that printing of money, which ultimately I think it's fair to say jobless recovery, printing of money, there is inflation, I just don't know when. So I want to try and work out how to protect myself from the when.
Yeah, I guess the when, probably for the course of this year, I don't think it'll probably be an issue. But if you're still kind of concerned, I'd say inflation-linked bonds are probably something to take a look at. There's a whole bunch of inflation-linked bonds on issuance here in Australia. There's also some specific funds that really just manage inflation-linked bonds. One thing that I'll probably stay away from is US tips. US tips at the moment are producing a negative real return.
Now, hang on. What's a tip?
Basically, it's a Treasury inflation-linked bond in the US. So what they're actually happening, there's been a fair bit of demand for them, and that's been generated by all the quantitative easing, with the Fed buying about $85 billion worth of bonds every month.
But who buys a tip? Give me a person. Is it PIMCO or is it RAD? Who's a tip buyer?
Well, it's probably the institutional guys that have been focusing on it, but there is access from a retail perspective to that market in the States. So I'd be staying clear of them for the time being, because basically, you might be protecting your purchasing power, but you're paying a fee for it.
Yeah, and a very expensive fee. And I think it's very hard to find. We had Chris Joy talking about inflation-linked bonds, and that's going to be my bond of the week. So I don't know how you guys were able to, segue that for me very nicely. But it's very true that that lack of purchasing power, we all feel it. We remember that when things were cheaper when we were younger, and we know that things will be more expensive when we're older. And we do look at that retirement bubble and say, how much money do I need to have? Because clearly, if you log on to anything, AMP, any of those sort of organisations, they show you that you really probably don't have enough. Particularly with the longevity issues, the fact that we're living longer.
Yeah, well, a lot of people solve that problem by using the growth idea. So people buy growth assets in order to grow out of that problem. So the problem, of course, is if you don't get the growth, you're in the wrong situation dramatically.
Right, so it's always a bit tricky to try and find the right one to go for. We head for the speed round. I'm going to give you the bond of the week, and it's going to be in the inflation piece. So bond of the week will be the Sydney Airport Linker. So inflation-linked bonds, it's trading at the rate of 4.4 plus inflation. So if we assume inflation at the moment is 2.5%, you'll end up with a net return of 6.9. It's quite a long-dated bond. It's a 2030 bond, but part of the key to these conversations right now is that you need to be as long as you can to cover for that inflation. You get a nice running yield close to the term deposit rate. We think it's a good bond.
At Nissan, the big one is back. We were first with 1% finance, and now it's back with 1% comparison rate across the Nissan range. We even put it on the all-new Nissan Pulsar. Get into your Nissan dealer by March 31. Leave it.
Want to know the best-kept secret for amazing deals? Then visit Quibbits.com, where thousands of customers save up to 95% on products like tablets, HD TVs, cameras, appliances, and more. Imagine getting a new Apple iPad today for just $33.93 or a Samsung 50-inch TV for as little as $61.43. At Quibbits, we do things a little differently. Auctions start at $0, and each bid raises the price by just 1 cent. The result? Insanely low prices. On Quibbits, you can save up to 95% off. And even if you don't win, you'll never pay more than retail. You can't lose.
I'm Brian, and I've won over 30 products and saved over $7,000 on Quibbits.com, the best place to get amazing deals online.
Stop everything and visit Quibbits.com. That's Quibbits.com. Go to Quibbits.com now.
With CFDs, I can trade on the rise and fall of indices, shares, forex, and commodities.
It's important I can pursue 24-hour trading opportunities and still control my risk.
I use CFDs when I want to trade the markets without putting up the full value of my position.
That's why I trade CFDs with IG, the global CFD specialist, creating opportunity since 1974.
I really want to make a difference and help people.
I want a job that I'm passionate about.
I really want to be a counsellor.
Well, now you can. Choose from over 45 health and community online courses at opencolleges.edu.au.
Welcome back to Your Money, Your Call, the Friday night edition of Bonds versus Equities, and I'm Mark Todd from FIIG Securities. Today we have Stephen Nash. Dr. Nash is from FIIG Securities as well. He's our strategist. We've got Rad Kraverbach, who's from 70 Capital. Again, gentlemen, let's move on. A balanced portfolio. We hear about it. You mentioned it before. It used to be 70% equities, 30% cash, and we see that in the chart. The Australian market's really familiar with cash. In your mind, Rad, what's a balanced portfolio for a retiree? So we're about to hit the retirement. We've got our $500,000, or we might have been able to save it to $1 million. We've really worked hard. What's his balanced portfolio or her balanced portfolio going to look like?
I'd say for a retiree, your risk appetite is significantly reduced, the closer you get to that retirement age, and it's really a function of trying to preserve the capital that you have and optimising the return out of it. So what you tend to want to do is move away from, I guess, asset classes that produce a lot of volatility with respect to those returns. So you probably want to reduce your equity exposure and then have a greater allocation, to fixed income. Now, I think historically Australia sits around the 9 to 10% allocation of fixed income. For a retiree, I'd probably look to push that to at least 25%, and it's probably more in line with countries like the Netherlands and Canada. What that will allow you to do is produce an income and basically protect your capital.
Doctor, I think the great rotation is actually the great rotation out of term deposits into equities. Everyone wanted to buy a bond-like performance in the equity market, Telstra, the majors.
Yeah.
That's a problem for the balanced portfolio, isn't it? Because they had so much in cash. It was that wealth defeating. When it was 10% Suncorp, that was great. But what's a balanced portfolio in your mind?
Look, I think a balanced portfolio gives you the idea that it will withstand the movements in the market, so you don't want too much volatility. The idea of balance means that the return is quite constant over time. with 75% equities, you're going to get, it's basically like an equity light portfolio, so you're going to get much the same movements as the equity market. If you flip that over to 75% bonds, you get a much more consistent return. Really, we recommend that people have own their age in bonds. So a 70-year-old might have up to 70% in bonds. A 25-year-old might have 25% in bonds and a lot more exposure to growth assets. But as you get older...
That's a nice tip, isn't it? It's your age in bonds. That's a good...
Own your age in bonds, yeah.
That'd be good. I've got 35% in bonds, that'd be all right. Let's move on to some of the global problems. Yeah. We looked at the great fiscal drag. Forget your great rotation. They actually went over the precipice, they had a look and they went for it. So the great fiscal drag is on. For the viewers at home, essentially they started to bring in some, in the United States they brought in some austerity programs around defence and Medicaid and different programs around that the Republicans don't like and the Democrats don't like, and they've actually did it. Normally they went at the last minute and they had an agreement on how to push it down the curve and kick it down, the can down the road. What do you think will happen with the great fiscal drag?
Well, unfortunately, it's a reality, and the sequester is basically kicked in as of about now. So I think it's about 85 billion worth of spending cuts over the balance of this year. What I think it will probably do is bring both parties to the table and come up with some kind of bipartisan plan. You know, ultimately, or in the current environment, the Republicans are probably being blamed for everything. So I think they'll want to sit down at the table eventually and work out some kind of agreement. What it means for the United States economy, it basically means that until they get that deficit under control, it's probably going to take a long period of time, that they're going to have benign growth figures for considerable length of time.
Doctor?
Look, I think during the week we've had Bernanke speaking, and he's been laying out what he's been doing over many years in terms of increasing growth. They've had a good record, growth has increased. There's really not much left that the Fed can do right now. What they don't want is this growth interrupted by politicians playing politics in the short term and getting that growth to stall. If growth stalls, it's going to be very difficult for the Fed to do much more.
Because he said that. He said to the politicians, don't do this, before it happened, and they did it. And the point would be that upon seeing a contraction in the GDP, they need to then kickstart it. They'll look to Bernanke and say, what do you want to do? And he said, I've done it. I've actually spent all the money. Yep. So it was moving. I had interest rates lower. It was happening. And now he needs to go and reprint. And he's worried it won't have the same effect, isn't he?
Yeah, I think they've done their easing to zero. They've done quantitative easing, and there's a lot of discussion about all the effects that's going to have. And it is quite a large program at the moment. So they're really going all out to get that growth going. They don't want it interrupted by a fiscal drag of the order of about 60 basis points this year. It could get worse as well. So, you know, there really has to be an agreement between the Republicans, and the Republicans are really blaming Obama.
They don't like him.
Well, Obama really implemented these sequesters in the first place, so they're going to say it's his policy, and they're implementing some spending cuts. I
mean, one of the things that I've been aware of that confuses me is the multiplier effect to these events. So the economists say, and the economists continue to get it wrong, and and it's hard. They say the multiplier effect will be half a basis point. So we think contractions will be half a basis point. You're losing your job, but you're all right, and you'll continue to spend because you've got your job. Well, I don't agree that that's going to happen. So I think the mindset of the conservative consumer is such that when they start to see this kick in, they will go back into their shells in a pretty meaningful manner. I think everyone who's got any memory will do that.
I think what they'll do is reduce their savings from what they are now, because they're going to be going on unpaid leave, and then after they're back in work, hopefully, that everything's okay, they will replenish those savings. So the effect of this could be quite a long and drawn out one, much more than what are the estimates are probably assuming a much more aggressive consumer. In this current environment, I imagine the consumer will be much more conservative.
Right. And would you?
I tend to agree with Stephen. I think the investor will take a big seat back, in the current environment, all the uncertainty attached to what's going on, and particularly if you take a look, I think the impact potentially is on about 800,000 jobs.
Yeah.
800,000 jobs. That's a pretty lumpy number. So if you're one of those people, you're definitely going to be sitting back and wait and see what's going on.
And it's not like there's anything you can do about it. You can't work harder. They just said we've just turned the money off.
Yeah.
Wow.
No, it is a problem, and the big problem is what sectors also get hit with it. So obviously it'd be the public servant sector. So there's talk of I guess customs. Big impact on the customs, border protection, etc. So the chaotic impact that could have going forward is unbelievable.
So we've got a little bit of time left. US election, the Australian election takes place. Will it affect investors at all? Start with you, Brad.
Yeah, I think it probably will. If you're taking a look at the polls, and the Liberals basically will win quite easily. So I think what that will provide is really some stability. And like most corporates, everyone's sitting around waiting to see really what happens. There's obviously a lot of discussion with the mining tax, the carbon tax, etc. Once that is predominantly resolved and everyone knows what's happening for the next 4 years, it's a lot easier to plan as a corporate going forward. And I think it'd probably be encouraging for investment in Australia.
What do you think, Doc?
I think the business sector will probably like coalition. Typically, they tend to decide that way. I think also the elimination of the carbon price might have an effect on inflation. Might bring it down towards the lower end of the band, towards the 2% level. May provide even further scope for the RBA to do some more work. So that could be quite encouraging.
What do you think about the employment market? If we have a change, how do you think employment at the moment? We've got it at about 5, roughly. What's your thoughts on employment for this year?
Yeah, I think it probably maybe drifts a little bit wider, I guess initially. But for all, Australia is...
so by wider you mean higher, so it goes from 5 up to 6, yeah.
So, yeah. And it's probably been seen over the last 6 to 12 months has been the manufacturing sector here in Australia has taken a pretty reasonable hit.
Yeah,
there's been a fair few job losses, etc.
Pretty tough.
Yeah, I think the unemployment rate is, from all the partial indicators, we're expecting it to drift up. And I think that will have a large effect on psychology. We've already got a conservative consumer, but with higher unemployment, it's going to give...
We love the conservative consumer. And gentlemen, thank you for coming. I'd like to thank Stephen Nash from FIIG Securities and Rag Kravovic from 70 Capital. That's it for us now. Enjoy your Friday. Next week we've got Chris Cuff and Chris Alcott. They'll be talking about developments in the retail bond market and Cufflinks, the new publication from Chris. That'll be great viewing. All the best. Enjoy that Friday night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.